Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly newsletter. Today's date is the 23rd of September. Let's dive into the week's stock market news. European markets dip as Fed's rate cut impact fades. BOE and Norges Bank hold steady. The Pan-European Stocks Europe 600 index fell 0.33%, reflecting investor caution as the initial boost from the US Federal Reserve's rate cut waned. Major European indexes saw mixed results, with Italy's FTSE MIB and France's CAC 40 index posting gains, while Germany's DAX saw a slight increase and the UK's FTSE 100 declined. The Bank of England maintained its key policy rate at 5.0%, signaling a gradual approach to future rate reductions. Governor Andrew Bailey emphasized the importance of controlling inflation and expressed optimism about further cuts once underlying price pressures ease. UK inflation remained steady at 2.2%, but service price increases, a key concern for the BOE, accelerated. Norges Bank, Norway's central bank, also held its key interest rate unchanged at 4.5%, with Governor Ida Wolden Barsh indicating that policy would likely remain stable through the end of the year. Several hawkish European Central Bank (ECB) policymakers advocated for a cautious approach to further monetary policy easing, citing persistent underlying inflation pressures. While some members expressed openness to potential rate cuts, they emphasized the need to monitor inflation data closely. Meanwhile, Eurozone labor cost growth slowed in the second quarter, offering some respite to inflation concerns. Now our insight into alternative markets. Fed's surprise rate cut, a mixed bag for private markets. The Federal Reserve's unexpected decision to slash interest rates has elicited a range of reactions from private market professionals. While lower borrowing costs are welcomed by dealmakers, the impact on private markets may be more nuanced and delayed compared to public markets. The reduced cost of capital is a clear boon for dealmakers, but private equity and venture capital-backed firms may not see an immediate benefit due to their different credit profiles compared to large, publicly traded companies. Startups, in particular, may need to exercise caution and wait for the full impact of lower rates to materialize before making significant decisions. Private credit firms are also facing adjustments. With cheaper debt available, they'll need to revise their terms to remain competitive, potentially leading to increased risk-taking and loan defaults. The Fed's rate cuts are expected to boost exit markets, which have been sluggish recently. However, larger deals like IPOs and buyouts may require further easing to gain momentum. Overall, the long-term effects of this easing cycle on private markets remain uncertain. While deal makers are optimistic, it's crucial to proceed with caution and monitor the evolving macroeconomic landscape.
Thank you for listening to this episode of Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode, and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, hubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.